So I want to try something new, maybe just do a series of shorter videos really covering some essential and important topics, in particular because of what's been going on with the markets. I know it's a pretty scary time out there, so I figure that it might be helpful to talk about, several concepts just so that people have some kind of grounding as far as what to do and how to think about these current very choppy markets and times. Welcome to today's 5-minute mini lesson in our new Finance 101 series, covering the fundamentals of basically anything you need to know in personal finance and investing. And today's question is, what the heck is inflation? So please stay tuned. Hey guys, welcome back. It's Phil from Build My ROI, where we empower you with the mindset and financial skills that you need to build and grow your wealth. If you're new here, make sure you click and subscribe and like this video and share it with your friends if you find value in our content. Let's dive in. So what is inflation? Well, the output of an economy is called its GDP, or gross domestic product. As an economy grows, this expansion is captured by an increase in the GDP. This growth increases price of goods in the economy, or in other words, causes inflation. Now, a healthy functioning economy has a baseline low to moderate 1 to 2% inflation, and is, for example, why when we buy assets such as stocks or real estate, or even when we start a business, we anticipate growth in the underlying value of those assets. That's normal. That growth we anticipate is over and above the baseline inflation in the economy. Markets where inflation far exceeds the economy's growth rate experience what's called hyperinflation. And good examples of these include Zimbabwe in southern part of Africa and Venezuela. So what does inflation mean for you and I? The simplest way to think about this is a dollar today is worth more than a dollar tomorrow. What that means is that a dollar has less purchasing power in the future than it has in the present. This decline in purchasing power of a dollar or any currency over time is what economists refer to as inflation. Economists measure inflation by tracking price changes in what is called the Consumer Price Index, or CPI, which is basically the price level of a fixed basket of goods and services. When the dollar loses value, prices in this basket rise, reflecting essentially an increase of prices in the general economy and consequently the CPI. This is what we are seeing today in 2022 with high prices in pretty much everything. And in fact, as of the recording of this video, as of last week, we saw a CPI number of 8.3% as of April, which is actually higher than what we had seen in a previous video that I had recorded when the CPI was at 7.9% back in February. So as you can see, the trend is not good at the moment. And this is part of the reason why we are seeing a lot of turmoil and volatility in the market. So to summarize in simple terms, prices go up, inflation goes up, dollar goes down. We buy less because we have a higher cost of living. And this ultimately results in an economic slowdown. So how then does inflation affect investment returns, which is why you are here? Whether you're talking about stocks or bonds, investment returns are generally impacted negatively by inflation. Let me explain. A simple way to think about this is the following mathematical formula. Real returns are equal to nominal returns minus inflation. In fact, you will often hear economists talk about inflation as an invisible tax. What they're referring to is this impact it has on nominal returns. In the case of stocks, inflation will impact these differently depending on the sector that these stocks are in. Because the Fed's response is to raise rates in order to counter inflation, in the case of high growth stocks, the valuation of these companies and hence their stock prices typically underperform in times of high inflation because the projected future growth of these companies declines. This is a key reason the high-flying stocks that were doing so well in 2020 and 2021 have completely falling out of favor and essentially all really hurting at this point. Now, how did we get here and what is the Federal Reserve doing about it? The last few years, the US economy and indeed the global economy experienced a major supply shock due to the pandemic as well as significant expansion in the money supply. Between 2020 and 2021, the US government printed record amounts of new currency, about $13 trillion, which is trillion with a T, which all went towards COVID, quantitative easing, and infrastructure. More recently, the Russian invasion of Ukraine has impacted the supply of commodities like oil, natural gas, and wheat. So the combined effect of the currency printing and supply chain issues brought on by the pandemic, as well as the Russian-Ukraine invasion, is the source of the inflation that we are experiencing. Now, one of the tools that the Federal Reserve uses to manage inflation is the Fed funds rate, which is the basis of interest rates in the economy. So this is why you're seeing the Federal Reserve start to hike the Fed funds rate. Most recently, again, the Fed hiked rates by 50 basis points or 0.5%. The result of the Fed raising rates is higher borrowing costs, which means higher costs in mortgage rates, student loans, credit cards, and so on. And that, ladies and gentlemen, is today's Finance 101 series on inflation. The next video that I'll be recording is actually going to be about recession. So please look out for that in the very near future. Please like, share, and subscribe if you enjoyed this content or learned something from it. I'm working obviously on many other videos and a lot more content, so do leave a comment if there's any particular topic, investing or personal finance, that you would like me to cover. Thanks for watching, and until next time, peace and love.